In this video, I want to discuss the subject about trading algorithms that work great in theory, but if you start these now, they will only result in losses and disappointment. Watching this video might give you one of the most important lessons if you are just starting to trade. This video is also a reaction to private messages I get from people that try trading algorithms after they have seen my video and find out after a few days that they do not perform that great at all. They get disappointed and angry because the results are different from what was expected. And this leads again to reactions I get in my mail or other media in which they express their frustrations. Now, first of all, I do not take these reactions personally, so this is not a rant to these people. I actually can understand them quite well because I experience the same too if I use trading algorithms. What you see here are two trading algorithms. The first one is one of my personal trading algos that is called the Arcane strategy, and it is still in development. I had tremendous results when I backtested it, and after a few months of forward testing or dry running with fake money, it also proved to be a really good algorithm, and so I decided to use this algo with real money. Lo and behold, this strategy does perform pretty well in live trading too, although the last couple of weeks it looks like it's starting to lose its edge. The second trading bot that I use with real money is using the NFI5 Moho algorithm. That algo had the best results overall on my strategy league, and after extensive forward testing I decided to put some real money to the line with this algo. Now look at this picture. It is just a disaster. Luckily I did not use my entire life savings with this account and all the losses are minimal because taking baby steps is the key here. But say that I added $100,000 to this account, then the losses would be much worse. And this is why I wanted to make something clear in this video. I will call this management of expectations. Now first of all, an idea of a new trading strategy or algorithm initially might seem to be brilliant, but we will have to find out if this holds up in reality too. Maybe using the idea in reality actually really sucks and your well thought out rules will not hold up in reality. To make an educated guess about the strategy's success without having to put your money at risk, we use a methodology called backtesting. In my videos on YouTube and posts on Patreon, I present results of backtests I do on these trading strategies. I use certain personal assumptions and settings, and these are based on my own personal experiences and preferences. Everything about it is explained in a very early blog post and on my website here at the bottom of this page. Now, backtests are a theoretical exercise designed to analyze past performance and providing insights into hypothetical future scenarios. It is a theoretical exercise because it uses and emphasizes the structured, analytical nature of backtesting. It is designed to analyze past performance, and this clarifies the primary purpose of backtesting. And finally, it tries to provide insights into hypothetical future scenarios. It actually conveys that the results inform future possibilities, but they are not guaranteed. The end conclusion of this exercise also has very distinct relations to this well-known expression, past performance is not indicative of future results. This phrase is frequently included in crypto YouTube videos or other financial disclaimers to remind traders and investors that historical success or trends in trading strategies, investments or financial products do not ensure similar outcomes in the future, especially given the unpredictable nature of markets. It's a caution against over-relying on backtested or historical data for decision making. Now, most of you are probably glancing over these warnings and say, whatever, but this warning should actually be taken very seriously. In trading, there is some wisdom that is not discussed much, or at least I could not find many people or channels that actually talk about this. And although I sometimes mention it in videos or posts, I also did not really make a real subject out of it until now. But after all these reactions from disappointed traders that started with great intentions and now might quit because of their negative experience, I decided to just make a post and video about this subject. It almost seems that this wisdom looks to be a secret that no experienced trader talks about, but it is essential information for a beginner trader, whether he or she uses a trading bot or starts with manual trading. And it might also be the key to why your strategy sucks in reality after promising backtest results. I personally think that this secret exists of 3 factors, and let me start with the first one. In this part, I want to talk about the concept of timing the market. Now, what is this elusive concept of timing the market? Investopedia says that market timing is the act of moving investment money in or out of a financial market, or switching funds between asset classes, based on a predictive method. Now, there is a discussion between the people that say that it is impossible to time the market, and others that do not agree and seem to have a good idea when to enter and exit. I myself tend to lean more to the first group, that time in the market is more important. However, I also sympathize with the second group. Especially in the short term, this is actually more relevant just after you decided to start to trade, manually or with a trading bot. In the end, I think it's a combination of both because of the second factor, and I will talk about that in a minute. But let me first illustrate what is meant by timing the market, and this will give you a good grasp of what is meant by this. Let's use an example. Say that you saw one of my videos and became so enthusiastic that you tested it out on your machine, with your pairs and settings, and you also had great backtest results. Maybe even better than mine, and you immediately wanted to start your trading bot today with that algo, because you do not want to waste any more time and want to get that gains. Now, what would you do at this exact moment? Say that this moment was at the height of the last bull market. Would you start it then? And what about at the trenches of the bear market? Or maybe after a few months when we have passed the bear market lows? Now, these examples are not fair, of course, because we already know the past, and you would probably say that you wanted to start your bot at the start of the bull run, somewhere in April 2024. Here we have an unfair advantage. So I repeat my question. Would you still start to trade today? I tipped you on the algo, you tested it and concluded you think you just found the absolute best strategy here. Would you still start today with your life savings and some of your parents' borrowed money? But say that this is a thought experiment. So you now started to trade and suddenly the market starts to dump. The strategy of which I so positively spoke about fails miserably. You start to lose and lose some more, and eventually you will stop the trading bot, one illusion less. Will you then say that my suggested strategy works like shit, and will you never ever trade again? Let's make things more positive now. Let's say that the market pumped like never before and the strategy works out great. It finally gave you the life-changing wealth, which I think you absolutely deserve. You returned everybody their money with interest and bought everything you wanted. And as a thank you, you would become an actual lifelong patron of me. This is for real, of course. But unfortunately, we don't know what comes next, and I hope you now can understand the dilemma. There's no way of knowing that if you will start to trade today, it will wind up winning or losing in the nearby future. I do think that it is possible to figure out somehow when to enter and exit the market, but I'm not there yet. And until that time, it's a matter of taking that leap of faith, having confidence in your own research and just start to trade, and try to anticipate on what's coming. And this is also the moment where I think the second factor comes into play. Because timing the market is a good thing, but time in the market is essential. And I'll tell you why I tend to favor the time in the market principle next. After this message. In the meantime, I want to thank you for viewing this video. And if you like what I do, then please click like, subscribe and click the bell icon to get notified on my future videos. If you want to enjoy discounts or other benefits on many trading related services that I personally use, like Bybit, TradingView, Linode and many others, then you can use the affiliate links that I have in the description below. Now first of all, time in the market is a patience game. You will have to start at a certain point in time, taking that leap of faith. Maybe things will work out fine and your trading bot will immediately start to make money, like I experienced with that personal algo in the beginning of this video. But it could also well be that your trading strategy does not make profits and start to lose money, like the second example I showed. And this is where the diamond hands and iron discipline and some faith come into play. Because you see, you have to look at the bigger picture, and this is why you also have to take initial backtesting and research seriously. The results of your theoretical experiment should give you insights into future performance, but the past does not repeat. It may rhyme, but it will not repeat. You also have to be aware that your backtests might spread over weeks or even years of backtesting data. So how can you compare the results of a few weeks of running your bot or trading strategy in real time with all those years of backtesting data? Maybe you stopped your bot after some disappointing weeks and the best days still lie in front of you, and you just stopped before the bot or your trading strategy started to win. In any case, besides timing, you'll have to take time in the market serious if you want to play this game. Do not fall for those get-rich-quick schemes and be aware of survivorship bias. It's a marathon, not a sprint. The third factor is not so much of a secret, but more a thing you should be more aware of. And this is the factor drawdown. Everybody who is trading or is watching my videos knows that I mention this performance indicator very often. Drawdown in the backtest tells you something about the possible future negative results of a trading strategy, based on the drawdown that happened in the past. Now, there is also a saying that the worst drawdown will be somewhere in the future, but the experienced drawdown in the past will be a good indicator of things yet to come. And again, this is part of expectation management. This past drawdown is something you can expect in the future again. And that drawdown might start tomorrow, right after you started trading, who knows. There is also something else that you have to consider with drawdown in trading, and that is the drawdown that you might experience when you just invest in crypto. In this extreme example, you can see that investing in coins might end up in a loss of 75%, top to bottom. And this is over the total market capitalization, so it could also be that some coins end up losing even up to 90% of their value. Now, if your strategy ends up losing 40 to 50% of your trading balance, you're actually quite lucky if you consider this. And the question is, which is better here? Now, you could say that no trading or investing at all is the most wise thing to do here. But again, these are considered opportunity costs because it could well be that the markets will rise and your money devaluates because of inflation if you don't invest in crypto or any other investment vehicle. So the message of this video should be clear by now. For those people that are new in this business and want to start their crypto investment or trading journey, or for those that already have started but do not get the results they expected, I created a few questions you can ask yourself before trading or investing. The first question you should ask yourself is, what does the market do currently, and is this the correct moment to start trading or investing? If not, under which circumstances will you start? And the second one is, if I take the step and start, what is the expected drawdown? Can I afford this loss financially and emotionally? And what will I do if the drawdown gets even worse? The third one, do I have the patience and the faith in my trading strategy, even if results are bad? And when do I realize that the strategy really has lost its edge, and what will I do next? And finally, what can I afford to lose? What's the amount of money that I'm willing to risk if my trading account blows? Will I sleep after that? Now, if you look to yourself in the mirror and have answered these questions sincerely, then it is time to slowly enter the market with a small trading balance and build further from there. You will not be surprised anymore and will be realistic in your expectations. You will become a better trader with a correct trading attitude. And with this newfound knowledge, I hope you will smash this market and get the wealth you deserve. And please click the like button and subscribe to this channel if you think this was valuable information. Become a patron if you want to support me in my journey to find the best trading strategy. And I will see you in the next video. Goodbye!